All right, everyone. Welcome to this special edition of The Final Bar on Stockcharts TV. I'm your host today, Dave Keller. I'm the Chief Market Strategist at Stockcharts.com. Excited to be here at the MoneyShow in Las Vegas, Nevada. It is not a rainy Redmond, Washington. It's actually quite warm outside if you've accidentally left the casino and experienced the warmth, which is a little rough for my thin Washingtonian blood, but I'm enjoying it a great deal. Joined on stage by Mary Ellen McGonagle from Simpler Trading. She hosts a show called MEM Edge on Stockcharts TV as well. I'd strongly encourage you to follow both of our shows as we try to navigate these markets the best we can. Mary Ellen and I were talking before we got started just about the challenges of doing an event like this during a week like this because outlines, maybe titles of presentations that you were asked to pick 4 months ago, things change, right? But to be honest with you, I think that's the nature of investing. That's the nature of the markets, and not judging by hair colors how long some of you have been investing. Some I think a little longer than me, maybe a couple of you a little less, but overall you've probably seen some of these downturns in choppy environments before. So I'm super excited to be able to share with you some of the tools on Stockcharts that we are using to try to make sense of things. Having an expert like Mary Ellen McGonagle, who's had great experience in the industry, working with, subtly well-known investors like Bill O'Neill and others that have, demonstrated the ability to weather markets like this, to get a sense of how someone like Mary Ellen is trying to navigate things. So what we're going to do is I'm going to briefly give you a sort of state of the market. And if you've followed my show, you've probably seen some of these charts before, but we're just going to talk about what has happened this week and how that fits into the bigger picture. And then I'm going to start asking Mary Ellen a lot of deep, open-ended questions about what do we do now? And we're going to talk about things like the great rotation of 2024 and mega cap growth stocks that looked impenetrable until they were very penetrable here in recent weeks. We'll talk about the rise and potentially fall of small caps and how quickly that has happened and what that means. We have a bunch of other things that all of a sudden have taken a back seat. The Fed, of course, top of mind. Geopolitical issues, the election season in the US, all of these things are sort of a fever pitch that is all building right now. So what do we do? And while we can't give you answers or recommendations, we can hopefully give you a lot of context and hopefully some good experience from previous cycles that we've been able to, as you can see by the fact that we're up at the front of the stage, have been able to survive. So let's talk about the markets at a high level. Obviously, this is a very much risk-off move for stocks. I feel like the markets before Wednesday and the markets after Wednesday had a very different look and feel, right? And if you followed the day-to-day movements, and if you followed me on the Final Bar, we talk a lot about a change of character, right? The market has a certain look and feel, and then something's different, right? You could feel from around 2:30 Eastern on Wednesday to where we're at today, Friday afternoon, everything feels like it has changed. Themes that appeared to be starting have now started to change a little bit. Rates have plummeted. The VIX has spiked above 20 for the first time since January, February. All of that has happened in a very short period of time. I've been having a lot of questions about whether this is a short-term pullback or the beginning of a deeper correction. And I don't have a crystal ball just like you don't, but what I will tell you is all long-term downtrends begin as short-term downtrends. And so we've started to see what could very much be the beginning of a move lower. And I think what Mary Ellen and I will talk about is how to sort of differentiate the tactical, actionable pullback that feels like a perfect buying opportunity and something that gets deeper and more protracted. And to be honest with you, I would argue following the chart is the most important thing you can do. So for now, the S&P has failed to hold its 50-day moving average. The weekly chart of the S&P, though, is still pretty good and still making higher highs and higher lows. So the long-term trend arguably is still intact. The second general thing I will tell you about is volatility. And I'm going to ask Mary, and I'm giving you a quick preview of things I'm going to ask you so you can start thinking of how you might want to answer it, because we did not go through specific questions ahead of time, but talked about some broader themes. And I would say the VIX is very high as of today. It almost got to 30 today. It did settle down by the close on Friday, just below 24. But overall, the VIX is the highest that it's been in 2024. I shared, and I forget where I mentioned this earlier this week, but my wife is big into weather patterns, and she loves the feels like rating on any sort of weather app or site, right? So the temperature is 100, but it feels like 110, and she never cares about what the numbers are. She's like, what does it feel like? When I walk out, what is it gonna feel like? I feel like the VIX has been below 20, feels like 60 for the last couple of weeks. And part of that could be zero DTE options, and maybe you're skewing the options data a little bit. But I would say the reality for investors and traders in the last couple of weeks has been a much higher volatility reading than the VIX would imply. The VIX would imply that things are actually slow and steady, not too bad because the VIX has remained below 20. Today, actually on Friday, we've spiked above there. So does that mean we're entering a new volatility regime? How do you manage through that sort of environment? Third thing I would tell you that's pretty key right now is interest rates. So, rates have been coming down quite a bit. This is just looking at the last year to show how the 10-year yield has dropped very quickly, below 4% for the first time since early 2024 on Thursday into Friday. Rates are now testing the lowest levels that they've been in the last 12 months, coming down from 5% not that long ago, right? So rates coming down tend to be really good for things like small caps, which need to borrow a lot of money to grow. Lower rates should probably be good for small caps, but are we seeing that actually reflected in the charts? Where should we go for yield if we're looking for income? If bonds are not paying the levels that they were, where do we find those income opportunities? So generally speaking, those are and those are just summaries, and there's a lot of other charts we could look at below, talking about market breadth, talking about sentiment, which has shifted very quickly, talking about individual names, which we'll hopefully be able to go through. But I want to do now is welcome Mary Ellen. Mary Ellen,
Sure.
Thanks so much for joining me today. This is awesome.
Yeah, it is. It's great. Great to be here.
And you've been on my show before many times. We've been on Stockcharts TV specials and all of that. And I've come to really appreciate your understanding of individual stocks, and you always seem to have ideas that are helpful. Hopefully, this is probably the most challenging environment. I've been asking you some of these questions.
Sure.
But thinking about how they fit into the bigger picture, I think is so helpful. So can we start out this way? We just looking at the chart of the S&P, we talked about sort of this great rotation of 2024, and certainly the things that had looked very, very good, particularly out of the April low, all of a sudden looking a lot less good, and June into July was a big change for a lot of those names.
Sure.
When you take a step back and look at the S&P doing what it's done so far, do you find optimism going forward? Do you find reasons to be more skeptical? Where's your mind at after a week like this and just a sudden retraction, I feel like?
Yeah, I would say that there is definite reason for caution, given what we've seen in the markets. And first up is the fact that we did experience loss of leadership. This is something I talked about in my MEM Edge report as far as those mega cap FANG names falling out of favor. And that, if you go back historically, now I'm not calling for a bear market by any means, but if you do go back historically and you look at difficult periods, whether it's a correction, anything a little bit more, the NASDAQ is already in a correction, it is going to be, that loss of leadership is going to be your first clue. So that is something certainly to keep in mind. And we are seeing within that swift move away from growth stocks, we're seeing a very swift move into defensive, which had been taking shape beneath the surface. But this week, REIT stocks, you're talking about yield and where you can seek income. Consumer staples, they're all pushing up to the forefront. And that happens when interest rates fall. We did see a big decline in interest rates, and oftentimes you will see investors seeking that yield in some of these more now defensive areas of the market. And a lot of those REITs and staples, they haven't really been participating. So you'll be able to experience oftentimes higher yields.
It's interesting when you think about, you mentioned the loss of leadership. 100% agree. You had mentioned when you're talking to your subscribers, you talk about like what sort of warning signs to look for, and those big leaders starting to struggle is often a great sign of a major reversal, and that's played out brilliantly. I mean, in some ways, the uptrend of the first half of this year was remarkably strong, but it certainly felt like a top would come at some point, right? So it was surprising, but not all at the same time, right? Did it surprise you how this reversal has actually played out? Or does this feel like the way that these sorts of names would normally behave, given this rotation?
So with those leadership names, and many of you I know follow the markets very closely, so you will have witnessed that topping, that move sideways, deterioration, breaking below support. So it hasn't been surprising in that sense, but the price action this week Wednesday afternoon through today has been surprising for me as far as the swiftness, the severeness, and we only need look at, if you wanted to pull up SOXX or the semiconductors, what took place last week. And we saw this sharp drop, and the reasoning at that time, this was after ASML came out with very good numbers, but it was because President Biden and President-elect Trump both came out with comments, and it had to do with policy. China and Taiwan, both very key areas for the semiconductors group, but there again, the response was just ferocious, right? It's, and really when you see that, and when you see what took place today with the VIX, the volatility, it has more of a panic feel to it. And that is really indicative of fear. And that, as you can see in what we've experienced, oftentimes in those fear-driven periods, you will see stocks drop a whole lot faster than they've gone onto their ascent. And it is an unfortunate nature of the market. And with that, you can take a close look at volume. That's going to be really your guide as we move through and look at charts. You will want to, if you are on the lookout for the markets to potentially be bottoming or reversing, you're going to want to see accumulation, because on periods like this, such as what we've experienced, when people do get out of the markets, institutions are going to tend to stay in, but self-directed investors oftentimes will leap. They are not going to be quick to get back in. So it's going, once burnt, your confidence, of course, will recede a bit. And so oftentimes that needed volume as far as accumulation, is this big money, is this real money that is supporting the markets and helping it to potentially turn.
You mentioned the VIX, which I had sort of teased in the introduction. Obviously, volatility has changed quite a bit here in a very short period of time. Mm-hmm. I've talked about VIX levels of 15, 20, and sort of different ranges and what that might mean. Do you have particular levels, or is it more the trend in the VIX that would tell you elevated fear, or is it, how do you sort of interpret volatility and what that means for the market?
Yeah, so the first key that I look for, and again, I talked about it in my report, is if you see that volatility index move up above the 200-day simple moving average, that's going to be your first clue that there is fear creeping in. Then up above that 20 level is very critical. And so what we saw today with it, the VIX was up 50%. And that is panic. That's a key cornerstone or sign of panic selling. So as far as selling into that, it's not advised. You're better off not selling into the panic.
You had mentioned the loss of leadership, the top performing names starting to struggle, mm-hmm. And that's part of sort of your overall kind of market top, I guess, checklist, right? Things you would look for that would tell you. What else is on that list in terms of market conditions? Like, what else would you look for that would differentiate a short-term pullback? Because I think so many investors, particularly newer investors, are sort of thinking you buy dips because that's usually what has worked. Mm-hmm. But all of a sudden, how do you differentiate a short-term pullback versus the beginning of a much deeper decline? Like, what's sort of in your toolkit to navigate that difference?
For me, it is going to be that longer-term chart.
Yeah.
You're going to want to zoom out, take a look at a weekly. And Dave, you did touch on the S&P 500 still holding above support. But if you look at that weekly chart, and this is something that I do regularly with my show when it is worthy, when that weekly RSI turns negative, it's not something you're going to see that often. So, but as far as these broader market indices, you're not going to see that RSI get below 50 that often. Mm. I also pay attention to MACD and other momentum indicators that on that weekly are going to have more significance for over an intermediate term period of time.
So we all get so drawn into what I call the flickering ticks, right? The short-term movements. But your point is look weekly RSI, weekly MACD as a better sign of a rotation. Is that fair?
You bet. For a longer term.
For sure.
Rotation.
Yeah, when in doubt, zoom out is what I was told early on. I think that's usually been good advice. We also, you alluded to defensive sectors starting to work, and that I think has been one of the biggest shifts we've seen from June into July and now into August. Things like utilities, REITs, which have been underperforming almost chronically, now starting to turn higher. Do you think that's the beginning of further outperformance by these sort of low volatility defensive sectors?
Yeah, so with REIT stocks, they are going to fare well in a declining interest rate environment. Of course, they seek growth by increasing their portfolios. They're going to be buying buildings and at a lower interest rate. So it's very beneficial to them. And then two, because they were underperforming, you're getting some really high yields. I did add a couple of REIT names a couple of weeks ago, 5% yielders, and they're faring okay, but it's a tricky period. But I do think that we have now two factors that would make that area attractive, that defensive nature, higher yields, and the lower interest rate backdrop. Consumer staples are a little bit different. We've seen some companies this week report earnings, and not all was great. Hershey and I believe Procter & Gamble, they didn't have great numbers, so that's going to be, of course, another component that you're going to want to take into account, not just whether the market is defensive or where yields are. You want to see the company on solid fundamental footing.
I feel like right about now it feels, and it goes in cycles, right? Sometimes the markets feel very macro driven. It's sort of like a big picture call. Other times it's very much a stock picking exercise. Think about, we're in the midst of earnings season, yet we can list off so many non-earnings related things that have market moving potential. The Fed this week, et cetera. Do earnings matter in a period like this? And can you tell me a little bit more about how you think, and we've had some like a Microsoft or something popping, Meta gapping higher on earnings. What do earnings mean at a time when the macro drivers feel so dominant in investors' thinking?
Yeah, they are still going to have an impact.
Yeah.
So if you look, for instance, Meta is up this week, despite a very difficult overall broader market. They came out with good numbers. You will see, if you look at the weekly performers, the best performers for the week, you will see names in there. These REIT stocks are coming out with good numbers. They funds from operations is what their metric is. And so it is still going to be very vital. However, if market pressures continue, those earnings are not going to make a difference. In fact, I'm doing a great presentation tomorrow about AI stocks.
A must-attend presentation.
That's right, that's right.
Tomorrow at 2 p.m.
And I'm chuckling because we all know what,
And I'd alluded to, this is a true story. You picked that topic, 4 months ago?
4 months ago.
So I'm excited to see what Mary Ellen has to say about AI stocks, given everything we've seen now.
What rabbit can I pull out of my hat?
So any suggestions you have for now? No, honestly, and what we've talked about, Mary Ellen, I think one of the great benefits for a lot of people attending a conference like this is learning from someone like you on what are you doing? None of us are, we're all kind of struggling to get our head around it. So I think that's pretty valuable.
So if I may, let me take you back to a period where I was front and center working with professional fund managers and taking us back to 99. And no one likes to think about that too long, but going back to that period, and there was talk about the AI bubble. Are we in a bubble? Is it going to burst, right? And there was some reference to internet stocks, of course. So I've been doing a lot of work preparing for tomorrow and taking a look at Qualcomm, and I'll be sharing with you what that market top looked like in 2000. It was toward the end. But I will also tell you that during that period when Qualcomm was just taking a nosedive, they were coming out with incredible earnings. And it also brings up a point that Bill O'Neill would often state, and that is, because I've held classes as far as uncovering big winning stocks, and how when the market shifts and we do begin to potentially go into a rotation and the markets may descend further, don't pay attention to Wall Street. because during that declining phase, and it's just been proven again and again, for instance, that Qualcomm, on that day that they reported earnings, the stock was in a free fall, and Wall Street top analysts kept coming out and saying, we like it, it's great, buy the dip. And so I have this slide, and it shows someone in a suit with their head in the sand. It's just so visual. I'm sure as a chart watcher, you're very visual as well. So that really kind of stuck with me. So the point there is a point, and that is that earnings, there could come a time when earnings don't matter. They're coming out with great numbers, but it's just a period of distribution. There's lack of confidence. There's a receding economy, rising rates, geopolitical issues, all those fears and uncertainties and the election that will overtake any earnings.
Just to pivot a little bit, seasonality, we're entering into usually the seasonally weakest part of the year, third quarter, going into a major low in September, October. That's been the play many years in the last, post-financial crisis, and even before that's been pretty common. Do you think we're setting up for a similar seasonal pattern here? And how much does seasonality fit into the evidence that you're seeing looking at the charts you do regularly?
Yeah, so August is renowned for being a tough period. Oftentimes it's blamed on the fact that a lot of traders are on vacation. We could point to any number of metrics, but the reality is, statistically, it is a very, very difficult period. The other fact is, if you look at the bigger picture, broader market, the S&P 500, and anytime, I believe it's 8, maybe 10 times, where the S&P in the first 6 months, if it's up 10% or more, it always struggles during August. So we have a couple of factors, seasonality plus that first half of the year performance that is not great, but...
So the strength that we experienced in the first half of the year may not be so great now going into the weaker part of the year.
To be honest, I thought we would maybe be down, I don't know, maybe a 1%, not to the extent that...
aggressively.
You bet.
What another big theme, obviously, in terms of seasonality is the election season, right? We're going into, starting to heat up for sure. The elections in the U.S. have taken on a dramatically different, feel here recently with the change in the candidates and all of that. How important would you say is the outcome of the election, given your experience of navigating these kind of periods, and how do you weigh that relative to some of these other macro themes we've talked about, rates, the Fed, et cetera?
Yeah, it's very critical. Unfortunately, it is. The beauty or what occurred as far as Trump potentially coming into being favored, we saw the markets trade higher. He's a known entity. We know his policies. We know he has cut corporate taxes. There's a sense of, among investors, of certainty. And with Kamala Harris now gaining in the polls, that is yet another reason that we're seeing this uncertainty and this fear in the markets. We don't know her policies. We can be assured that it will be along the lines of Biden, but we haven't seen her in a leadership role. Will she be able to handle China and other issues? I'm sure she will, but the uncertainty is out there. So that's another factor driving the markets. And I can also talk to other political periods, times going into the election, and depending on what is critical at that point in time. If you look at during Obama, his pre-election, there was a lot with managed care, or with Obamacare, sorry. So we did see a lot with healthcare. Healthcare was all over the place. So you will see when there are particular candidates that are moving through, depending on key items that are important to them as far as getting passed. We've seen with Biden the infrastructure and the money that he's poured into that, and how that really has helped a lot of those types of companies. So policy is going to get more important as we move closer as well. But once that uncertainty is behind us, oftentimes we will see, of course, depending on the economy, we will see a nice uptick.
Another big, and again, I feel like our cup runneth over with macro themes to maybe talk about, but I'm curious how this fits into your thinking. We obviously talked about interest rates, the 10-year yield coming down, the Fed, most likely starting a rate cut cycle here at the next meeting in September. Does the prospect of rate cuts through the remainder of this year, maybe into next year, how does that relate to what you're seeing technically? Because I think of you as someone who really has a fusion approach of looking at the charts, but really understanding these companies and what they're doing. How does that Fed activity through the remainder of this year relate to what you're seeing technically, and how do you marry the two?
Yeah, so what you're seeing now is very different, what you've seen, because from Wednesday through today, we've gotten some soft economic data. So the thought of a reduced interest rate does not have the same thinking behind it. Before, we were thinking soft landing, the economy could continue to grow. GDP is at a very healthy rate. And now we've seen soft economic data, employment data that is not good. So suddenly that interest rate drop takes on a different tone. It's coming from fear. Oh my gosh, the Fed blew it. They should have dropped rates by now. They didn't. So it is generally good for the markets. It's good for growth stocks and small caps. But again, just over the last several days, the reason for that rate cut has shifted dramatically. So it's not going to have that positive.
Sadly, we're getting near the end of our time together, which I'm super sad about, because I'd love to keep talking forever. And I do want to make sure some of the attendees here have an opportunity to ask questions before we finish. But I would love to just wrap up our discussion about what do we do now, right? I mean, how do we sort of position? You mentioned some things like defensive areas of the market. Have you seen enough now to think you need to start rotating defensively? How are you managing, mega cap growth positions that have probably swollen to, very elevated levels with the rally? How do you navigate that and those, obviously shrinking in value versus some of these other areas that are improving? How do you think of positioning in this sort of environment?
Yeah, so in this period of rotation, it hopefully has come to you naturally that as your stocks break key support, you exit. If you're a longer term investor, you can conceivably use that longer term chart to keep you in the stock. But by now, those mega cap FANG, most of them are below their key 50-day, and you should have or reduce your holdings there. And I think, obviously I'm going to do quite a bit of work over the weekend, but it's going to be interesting to see how we progress from here, because again, today was a panic selling day, but I think it's going to take time. I talked about that as far as relating to when we see the markets drop and how quickly it has occurred. We're not going to see people running to get back in. There's just too many issues right now, too many areas of uncertainty. It will take time to repair, and I wouldn't suggest buying on this dip, obviously.
Wait to see how things play out.
Yes.
I'm curious with something, and again, not to start individual stock discussions too much, but more broadly speaking, something like GoDaddy is an example. Internet name made a new all-time high today. Popped higher while everything else seems to be going down. Mm-hmm. When you see sort of a risk-off move, as we've observed in the last couple of weeks, do you unwind a position like GoDaddy because of the macro weakness? Or, again, thinking of you and your work with William O'Neill, I remember reading Investors Business Daily through downturns, and there were always good charts there. I mean, there were good charts to be found. What gives you the confidence to, own a name like that during a period when the markets are sort of in dislocation?
Yeah, you will see that. In fact, going through, just looking today before our talk today, there are names that are holding up, and you will see that. You will, as always, pay attention to that chart. Use that daily chart as your guide. Again, if it breaks support, that's going to be very critical as a time to reduce your exposure. And that's still going to hold true regardless of what area the stock is in.
I'd love to pick your brain as a final question of words of wisdom that you picked up. And I don't think you brag enough about the benefits of working with someone like a Bill O'Neill, who, a legendary investor and educator. Many of us have probably, I learned investing reading David Saito Chung and others who wrote fantastic work inspired by O'Neill. You had mentioned as we were talking before the event, don't try to predict the market. Can you tell me a little bit more about that? Because it feels like a lot of us are sort of in the prediction business, even though we probably don't want to be. What does it mean to you not trying to predict the market? What are we trying to do then?
Really, what Bill O'Neill just said incessantly and in a good way was that it is not, as investors, our job to interpret and predict the markets. Much, much better and beneficial to watch the markets closely and respond. Use those guides, use those rules that you have as your guidepost, and it will really help you in the long run. There's no crystal ball out there, and you really will be better served if you have a solid system in place and you utilize that. So oftentimes in my report, I will suggest this might happen, but if this happens, this might happen. So it's just a really much more confident way to approach the markets rather than have this grand prediction.
Okay, I have one more question. Sorry, I lied. That was a lie before because I remembered we didn't talk about commodities at all, and I'd love to think. Yeah, sorry. It happens. Gold is one of those few things at all-time highs or very near. So, and a lot of those stocks have kind of chopped around, but AEM gapped higher on earnings. You've had some gold stocks that are improving. Is gold one of those plays that makes sense in this sort of environment, and why or why not?
Well, it's definitely still viewed as a flight to quality play. Yeah. And I don't think we're seeing it as pronounced as in other periods similar to now, but it makes sense. It's not surprising in any level.
Yeah. Folks, this was a lot of fun. I appreciate you hanging with us as we had a live conversation.
Yes, thank
Mary
you.
Ellen and I have spoken a number of times, usually on Zoom, so this is cool to actually do it in person. So thank you guys all so much. And as a reminder, Mary Ellen does a show once a week on Fridays.
You're right.
On Stockcharts TV. I do a daily market recap called The Final Bar. Thank you all so much for attending. We appreciate it.
Thank you.
Thank you so much.
Oh my gosh, thank you.